To incorporate or not incorporate? Very popular question. I get asked this at least once a week, and here's the answer. It depends. It depends on you and your business and the situation that you're in. That's why it's very important to understand each type of business and its characteristics to understand which one suits you the best. In Canada, most businesses are run either through a sole proprietorship or a corporation. In a sole proprietorship, you and the business are one. What does that mean? At the end of the year, you go to your accountant. He or she will add your business income, subtract any business expenses. Whatever's left, net income, gets added to your personal tax return. And you get taxed depending on what tax bracket you fall under. For example, in Canada, the first tax bracket, 0 to 50,000, is 20%. Now, what are some pros of running a sole proprietorship? Number one is there's very low startup costs. Also, very low maintenance throughout the year. So if you're just starting a business or you have a side hustle, it's always nice to start off as a sole proprietorship. You don't have to make those big investments. What are the cons of a sole proprietorship? Well, the personal tax rates get pretty high. Again, for example, here in Ontario, the combined federal and provincial tax bracket, if you make $235,000 a year, is 53.53%. So that could be very heavy come year end if you're making a lot of income in your sole proprietorship. Also, there's not a lot of tax planning you can do in a sole prop. You have your business expenses, you have your income, you subtract the difference, whatever's left gets added to your tax return. You don't have a lot of opportunities to tax plan. Now, who should open up a sole proprietorship? I touched on it a little bit earlier. If you're just starting off in business or if you have a side hustle, it's always nice to start off as a sole proprietorship because you can always open up a corporation down the road if it makes sense for you. Also, if all the money you're making in the business, you need to consume to pay personal bills like a mortgage, rent, groceries, auto bills, then it's always best to open up a sole proprietorship and avoid the high cost of a corporation. I'll go into a little bit more detail about the difference when I talk about a corp here in a sec. So, sole proprietorship, pros and cons. Now let's talk about a corporation. In a corporation, you and the corporation are two totally different entities, which means whatever happens in the corporation is separate to what's going on with you personally. So God forbid something happens in the corporation, there is a wall of separation between you and the corporation. So pros, just touched based on it there, there's personal liability protection. So like if God forbid something happens in your corporation, you are protected. You have assets personally, those are protected. Or if you're being sued through the corporation, you personally are protected. Also, there's this thing called the small business deduction. In Ontario, the first $500,000 of active business income is only taxed at 12.2%. Now I know what you're thinking. Well, why would I open up a sole proprietorship when I can open up a corporation and only pay 12.2% tax? I'll explain that in a minute. So there's personal liability protection and small business deduction with a small tax rate of 12.2%. Now, what are the cons of a corporation? There are higher startup costs when it comes to opening up a corporation, high maintenance and high maintenance fees throughout the year too when it comes to running a corporation. Also at year end, you have to do a corporate tax return, which is an additional cost, also an additional responsibility for you. So let's pretend you made $70,000 in a corporation, but you had to pull that money out to fund your personal day-to-day living when it comes to bills and such. So when you pull out the $70,000 out of the corporation, that's going to get taxed at your personal tax rate, because when you pull that money out, you have to give yourself payroll. You can't just pull that money out like it's a sole proprietorship. So you made 70, you pulled out 70 via payroll, that gets taxed at the end of the year based on your personal tax rate. Now, within the corporation, you have to do a corporate tax return, but there's nothing that happened in the corporation in terms of taxable income because you made 70, but then you pulled out 70 via payroll. So now your income in the corporation is zero. So you're not really taking advantage of that 12.2% corporate tax rate. However, you're stuck with high startup costs, high maintenance fees, and you're stuck with a corporate tax return at the end of the year. That's why I'm saying if most of the income you're making as a business owner, you need to consume personally, maybe a corporation isn't for you. Now, let's pretend you made $200,000 in a corporation and you pulled out 70 via payroll. Again, that 70 is going to get taxed at your personal tax rate, but the remaining $130,000 is going to get taxed at 12.2%. Now, you're going to be left with a lot more money in your pocket to turn around and reinvest in the business because of that low tax rate. So you can invest that money in supplies, equipment, employees, whatever it is that you want to invest in, but you have a lot more now in your pocket because your tax rate is so low. That is how you take advantage of a corporation. When you have more money left over in your account, in your corporate account, then you need to pull out via payroll to go ahead and hopefully build your empire. So now that you understand the two major types of businesses and how they work, you can kind of make a decision which one's best for you. Hope that helps.